Well, hello traders. My name is Chris Weston, Head of Research here at Pepperstone. So a new week, new opportunities, new event risk for us to sink our teeth into. We're very much interested in what's happening in the US. I think if midweek we've got the FOMC minutes. Whether that causes volatility, I'm not so sure, but certainly we will be focused on just how close they are to raising rates at the December meeting. At the moment, the market believes that's a pretty sure event. The market's pricing about 72% probability of that. We have seen a little bit of rate hikes being priced out of the interest rate curve recently, and of course that's a reflection of not just Donald Trump going after the Federal Reserve, but also the fact that we have seen a sharp tightening of financial conditions with the equity market coming under all sorts of pressure, implied volatility through the VIX index moving up to 25%. And of course, we've seen a big reduction in liquidity as well. There's been a big reduction in positioning certainly from the trend following crowd, or what we call the CTA crowd, and also from a lot of the quant funds as well, and the volatility targeting funds. As volatility's increased, the rule-based systems from some of these funds has dictated that they have to reduce their positioning and go more into cash in that situation. So if you look at the futures volumes that have been going through the S&P on late last week, we saw some massive volumes coming through. Certainly on Thursday night, we saw that about 4 million contracts, which is probably the second biggest of the year. So as we go through the new week, we will be looking at the Fed minutes, but we'll also keep an eye on, in the US, on micro. We've got the meat of earnings season starting to ramp up, and of course people are expecting some positive numbers there. We're expecting about 21% EPS growth as a group and about 11% revenue growth from there. So what will corporate CEOs talk about the Trump tax policies, the potential for infrastructure there, what are they saying about the US dollar, what are they saying about Brent and US crude prices, and really the reflection of the outlook and the tone of voice will be reflected in price action in the markets. But of course, we want to see whether the S&P can regain this 200-day moving average, whether it can regain the longer-term uptrend which it recently broke, and whether we can see more constructive moves, or whether this downtrend that we've been seeing of late can continue in earnest. We're going to be focused on China. The good news there, of course, is that we have heard that the US Treasury Department are not going to label China a currency manipulator. I don't think that's going to surprise too many people. I think if we had seen that happening, we would have seen an all-out collapse in markets. People would have got very, very concerned about the relationship between the US and China, which actually could be on a slight mending trajectory here. We have heard that next month we will be seeing President Donald Trump and President Xi meeting up, so perhaps tariffs will come to a more constructive dialogue there. But in terms of China, we are watching their equity markets. They're under all sorts of pressure at the moment. We've got the CSI 300, the less broad Shanghai Composite, as you will, down 22% for the year. But we're going to be focused also on their economics. So on the back end of the week, we get GDP numbers. We've got the CPI numbers coming through as well. We've got retail sales, industrial production, and fixed asset investment. The GDP numbers should come in around 6.6%. We've got no reason to believe they're going to deviate too much from those consensus numbers there as well. But we are very much focused on what's happening in that Chinese equity market, because it's under all sorts of pressure, and the idea that there is a feedback loop between weak Chinese equity prices and the real economy is something that's very real. We can see property under all sorts of pressure as well. So China is very much on the focus point, as is the relationship with Donald Trump and the US trade team there as well. In terms of here in Australia, well, the big one is on Thursday, where we get the employment numbers. It's a massive lottery. No one actually has any kind of real clear insight how that's going. But we are expecting around 20,000 jobs, or at least that's the consensus. And the Aussie dollar could get a bit of a benefit if we do see that unemployment numbers staying below trend at the moment, and that's something that we're watching. But in terms of other assets, I think you've got to keep an eye on sterling through this week. Sterling yen's the one that I really want to focus on. Of course, cable has moved back through 132, but we've got the Brexit negotiations coming to a real pointer with the EU summit on the 18th. It does look like a deal is going to be put on the table there. That's certainly been the talk there. The market's getting quite excited. But I want to look at sterling yen, because I think that's a really good proxy of what's going on there. You can see on the weekly chart or the daily chart that we're consolidating in price. I want to buy a breakout through that sort of 149 level, or what we can see from that bearish outside day, a reversal or a break below those kind of lows around 146, and I think that could define the trend in sterling yen. I want to go along with that, but of course, we will be watching to hear narrative coming out of that as well. It's been hard to trade the pound, of course, but we're watching sterling yen. Oil prices as well, if you have a look at the weekly chart, you can see some really strong rejections of some of this confluence of resistance levels coming into sort of $76, $77. A break of that on a weekly basis would be outright bullish. I think we'd be looking for $100 oil prices in that environment. Failing that, I think if you get a close on the weekly basis below 64.43, then we could be going much lower in oil prices as well. I think until that time, oil prices are going to chop around there. I think that's a really important chart just because of inflation expectations, what that means for currencies as well. So we've got oil prices very much on the radar there as well. We want to keep our eyes on what's happening in the dollar, but I think that's going to key off what's been happening in US fixed income and general sentiment around holding US assets where there's been a big concentration risk of late. So there's a lot to focus on. We're keeping our eye very firmly on what's happening in US equity markets. We're keeping our eye on Chinese data and equity markets there, whether we're going to get a reprieve in the US dollar, and of course what happens in US fixed income, given that has been such a source of implied volatility there.